Hello everyone, welcome to another QuantInsti webinar. This is your host Kshitij Maurya, and today's session is on Introduction to Medium Frequency Trading, which will be conducted by Dr. Ernest Chan, who is one of the leading industry experts in the domain of quantitative trading in finance. He is joining us from Ontario, Canada. Uh, Hello, Dr. Chan. Welcome to another QuantInsti webinar, and thank you for taking out your time and joining us today.
Thank you, Kishiti. I'm very excited to be here. Thank you for inviting me.
Great, perfect. So, a very quick introduction to Dr. Chan. Dr. Chan is the CEO of the financial machine learning firm PredictNow.ai, and he is an award-winning quantitative hedge fund manager and acclaimed quant finance author. He was previously a machine learning researcher at IBM T.J. Watson Research Center and Morgan Stanley, and a proprietary trader at Credit Suisse. So, before we start with today's session, please note that. All your questions will be answered after the presentation. So we have this Q&A session at the end, so where you can ask all the questions, and we'll try to pick as many questions as possible. And also, this session will be recorded and will be uploaded on our YouTube channel. So you can access it anytime, and you can also share with some of your colleagues or friends who have not joined here today. So yeah, so without any further ado, let's straight dive into the session. And Dr. Chan, the stage is yours.
Thank you. Hi, everyone. Thank you for coming to this webinar about MFT, which I think you won't hear this particular term very often. So you might wonder, why should you be interested in MFT? Why should you learn about MFT? And I will try to answer that in our first slide. First of all, have you heard of the flash crash of 2010? Do you think that if it will happen again, and how would your trading or investment be impacted by it in the future if it happens again? So we need to find out what caused it, and in fact, how could you benefit from it? And I say benefit because many people think of flash crash as a horrible event, some distortion of the market that should be avoided at all costs. But as trader, I can tell you, you can benefit enormously from such occurrence. In fact, the flash crash was one of the best trading day of one of our strategies. One of the best trading day of our strategy. You heard that many high frequency traders have withdrawn liquidity, they've stopped trading. Not us. We were able to benefit enormously from the flash crash of 2010. So we need to understand what drove it and what to do about it if it happened again, or what to do ahead of it in anticipation of it happening again. So there are other questions that are related to what we will discuss in this course on MFT. Do you know that there are 50 trading venues for stocks or ETF in the United States? Over 50. Which one have you submitted your order to? Which one should you submit your orders to? If you don't choose, your broker will choose it for you. And which ones your broker will route your order to? Is your broker looking out for your benefit, or is it looking out for their benefit? That's a very important question. They may not be routing your order to a place that benefit you most, but they may instead be earning payment for order flow, PFOF, that get paid for routing your orders through certain market makers, right? So that is a question that you need to ask yourself and your broker. Where are they routing your order? And you may have heard of dark pools. Some of these trading venues, in fact, many of these trading venues are the so-called dark pools. What are dark pools? Should you use them? Are there any benefit to using them? We will find out in this course as well. And then, we are all familiar with the simple order types like limit orders, stop orders, market orders. But have you heard of IOC orders, ISO orders? Should you learn more about them? Will they be useful to you? We'll find out as well. And last but not least, order flow. What is order flow? How do you compute it? What is the benefit to computing order flow for your trading? That's another topic that is related to market microstructure and medium frequency trading. So now let's define what MFT is properly. That's my definition. It's nobody else's definition. Okay. So when people say high frequency trading, HFT, that's something everybody familiar about. Typically, high frequency trading, we are dealing with latency of less than 1 millisecond, sometimes even nanosecond these days. So MFT, which we call millisecond or medium frequency trading, has a latency of about 1 millisecond to 20 milliseconds. That is the frequency that is relevant for, I would argue, all trade executions. Whether your holding period is 1 second or whether your holding period is 1 week or 1 month, we are all medium frequency traders, because just because you're holding a position for 1 month doesn't mean that you can ignore the execution issue, because when you execute intraday particularly, you are in the realms of MFT, no matter how long your holding period is. You need to learn about these special order types. You need to learn about this special, the various trading venues. You need to learn about co-location, order types, optimization, and so on and so forth, in order to minimize the impact of your order, even if you're holding a position for a whole month. Just ask every large hedge fund. If they're not doing it themselves, they are hiring a specialist firm to do it for you and paying them a fee. Now, when we talk about low frequency trading, that has latency of greater than 20 milliseconds. But low frequency trading simply means that you're holding position for a long time. But when you execute, it actually is still in the realm of MFT. So latency is measured in many ways. There is computational latency, how much time it takes your program to decide which order to generate. There's order submission latency, the time between your program's order submission to the time that the exchange receives your order. And then there's market data latency. That is the time between someone else's order's execution and your receiving notification of that trade. And then finally, there is order status latency. That is the time between your own order's execution and the time you receive notification of it. So now that we are clear on latency, we can now state clearly that MFT is the realms of any intraday trading. You are not really trying to take advantage of the slow traders. You are not trying to benefit from sub-millisecond arbitrage. That's not your goal. You are not a high-frequency trader. In fact, it's very expensive to become a successful high-frequency trader. But you may be just a very pedestrian trader, trading once or twice a day, or you are a very long-term investor that trade once a month. Hey, but you are nevertheless an MFT because you want to execute very well and not to be subjected to all these other nefarious activities that are happening in the marketplace. So the profit of your trade may be large enough to not be affected by a sloppy execution, but why give away profit, right? Just because you can tolerate losing money doesn't mean you should lose money. So anytime you execute intraday, you are in the realm of MFT, as I mentioned. Why are these profits sensitive to intraday market microstructure and all these other issues related to the MFT? Well, there is, of course, gaming by the HFT. In fact, even in 2010, 70% of the US equity market volume were already due to HFT activities. You can imagine that has only grown since then. That led to very thin top of book liquidity. I will show you an example in the next slide. How shockingly thin the top of book liquidity can become. Then there is all kinds of complicated order types, routing methods, and dark pools with different rules in the US equity market. That may not be relevant if you're not trading US equities, but if you are trading US equities, and to be honest, most of this course is about trading US equity. It's not about trading, although some parts are relevant to trading futures and some parts are relevant to trading Forex, but a lot of these order routing issue and venue selection issues is concerning trading US equities, right? So that's all these complicated structures in the US equities, which is of course one of the most liquid pool of liquidity in the world. You know, they affect your profit if you don't know about the intricacies of them. And then there is the issue of adverse selection, which happen across the board, whether you're trading equities, futures, Forex, and so forth. Information leakage. When you trade, the fact that you send in orders and the fact that certain orders are executed reveal your intention to others. It's like playing chess with 1 million other people. Every move that you made leak information. Sometimes you leak more, sometimes you leak less. Actually, that's the reason why people have started so-called dark pools, to avoid certain information leakage. But funny enough, dark pool is not completely dark, as you will find out in this course. And then there are mini flash crashes, and then there's withdrawal of liquidity, all of which have certain, sometimes to do with HFT, sometimes to do with illegal market manipulation. Other times it have to do with certain order types that are being used by HFT and other players. It's all very complicated, but I'm hoping that we can tease out many distinct threads from this complex web of related issues in this course. Okay, so I promise that in the next slide, I'm going to show you a very shocking example of how HFT activity in the last decade have affected liquidity. I capture a screenshot of Interactive Brokers. It's a real screenshot. It's not, you know, I can't remember when it was captured. You know, it's probably around 10 years ago. And this screenshot shows the Apple top of the market liquidity. And I want to draw your attention to what? Let me draw your attention to two numbers. Let me see. Let me get my pen set. These are the two numbers I want to draw attention to. 1 and 1. Well, I don't know about you. I was shocked. Even a stock as liquid as Apple only has 100 shares of top of book liquidity in the middle of the trading day. We're not talking about after hours trading. We're not talking about you know, at the you know, at the beginning of the market trading day. This is like 11 a.m. during the market day. This is the timestamp. I'm glad that Interactive Broker provide timestamp for everything. This is 10:58 Eastern time. Now, this might be a particularly bad day for liquidity, but if you read this book by Carty and Professor, actually, I only remember the first author's name, Carty, C-A-R-T-A, which is referenced in our course, by the way, called Algorithmic and High Frequency Trading. They will tell you that they have carefully measured the average top of book liquidity of Apple, and it is about 300 shares. Not as bad as what I show you here, but it's just 300, right? Okay, so why is that? That's because market makers are getting smart. They don't want to be picked apart by the high frequency trader. So, oh, I'm sorry, it's not 300. This is the number. Oops. 189. That's the number that Professor Carty wrote in his book, Algorithmic and High-Frequency Trading. They calculated about on average, it's a 189. Not a lot higher than the 100 that I quoted, right? So the reason for that thin liquidity is because the market makers, they are aware of all these games played by the HFT. They do not post large order at the top of the book because those will be picked off in no time and cause them to lose money. And some of these market makers are high-frequency trading. Many of the market makers are high-frequency trading themselves. So everybody is gaming each other. So therefore, it reduces the top of book liquidity to such size. But that has big impact. That has big impact on backtesting and trading because the top of book prices oftentimes are used for backtesting a strategy. And if that price has so little volume behind it, it becomes irrelevant. So you actually have to really use a certain market depth to backtest anything realistically, because nobody can make money by executing 100 shares, right? I mean, unless you're a retail trader. But any serious algorithmic trader, institution trader, cannot make money assuming that they are only going to trade 100 shares of Apple. Therefore, practically everybody who are serious institutional traders need to use the order book for backtesting the strategy as a result. So it has big important consequences. Now, that is not the only issue. There's the other issue is that much of the liquidity is not even displayed. They can be hidden orders, but most importantly, they can be orders that are placed in dark pools, executed away from the lit market. The market that displays the national best bid ask is the best bid offer is called the lit market, and the dark market, which are happening in dark pools, they do not show the order book to you. That's the whole point about dark pools. You don't know what is in the order book. And 1/3 of the shares in the US are traded in dark pools. So you don't see the order displayed, but you do see the execution. The execution has to be reported to FINRA after the fact. And I emphasize after the fact. So that is, so you won't be able to use that execution as, to judge whether there's enough liquidity for you to execute your strategy. So it has some impact both on backtesting and on live trading. Oops, let's see, I somehow have disabled my screen share inadvertently. Hopefully it's yeah, it's still there. Okay, very good. Okay, okay, so since time is running short, let me just go through the one interesting issue that has to do with HFT activities, and that has to do with the flash crash that I have been so excited about. There is a particular order type called ISO order, which you will learn in this course, that has particular relevance to flash crash. Some academic papers suggest that ISO order or intermarket sweep orders are what causes flash crash, because they allow a order to stay on a particular venue and sweep the order book instead of being routed to other marketplace that has more liquidity. All right. So now, yet others, so there are many papers who talk about ISO as a possible reason for flash crash, and yet there are other researchers believe that, hey, it is because the flash crash was occurring because the market makers was withdrawing liquidity because they feel that there's a toxic flow. And again, the concept of toxic flow has to do with a large order flow. And again, order flow is a key topic that we will discuss in this course. So when the market maker detected this informed order flow, they withdraw liquidity and causes the price to drop precipitously that day. That was proposed as a reason. And finally, there are others who believe that spoofing is the cause. Spoofing is a illegal market manipulation where you are sending a lot of orders that you never expect to execute. You send in the orders and then you cancel them. Send them in and execute and cancel them. making people feel that there's a large order coming in, but they didn't realize that you keep canceling the orders that never get canceled. Now, this guy, Navinder Sarwar, a UK retail trader, was convicted by the US federal court for smoothing. It's illegal, and he was convicted by US court, even though he lived in UK. So he was, I don't remember if he was extradited. It was talked about in the book Flash Crash that you can read about. So we will talk about spoofing. What is spoofing? Well, don't try it because you don't want to get convicted by US federal court, but you need to learn what it is about and how it could have led to Flash Crash, because certainly the court is convinced, the judge was convinced that spoofing causes the Flash Crash, which many people are skeptical of. One retail trader? Are you serious that one retail trader can cause the US equity index futures market to collapse? It's kind of doesn't sound right, but hey, who is to argue with a US federal judge? Okay, so I think dark pools, there are many issues with dark pools. How are dark pools constructed? Should you use it? There are about 40 dark pools last I checked in the US. And the key point about dark pools is that the orders are not displayed, and it is like an auction. They conduct auctions at various times in the day or even continuously, and the auctions are automated. That is to say, most of the time you get executed at the midpoint based on the NBBO, National Best Bid Offer. So every time you put in an order, you have no idea where it will execute, but you know that it will execute at a fair price. It's whether you're on the buy side or the sell side, you will get half the spread. You only pay half the spread because it executes at the midpoint. That's the theory. So it sounds pretty good if you have a large order and you don't want to pay the bid-ask spread and you don't want to have opportunity cost, send it over to the dark pool. I did that once. It was pretty good result. But it depends on which dark pool we're talking about. By the way, I think the dark pool I sent to was run by Goldman Sachs. So to their credit, it was a good dark pool that I enjoyed sending orders to. But who knows? That was 10 years ago. But the dark pool can be manipulated, and we will talk about the manipulation of the certain dark pool. So you need to be careful which dark pool you send your orders to, because there's the issue of adverse selection, and you can measure. There's a measurable impact on how adversely selected your orders can be. So even dark pools is not completely dark, and there are issues to avoid. There are issues to deal with related to that as well. So talking about actually the physical infrastructure of implementing what we talk about in this course, that we will talk about on this online course. What is the physical infrastructure that you need to have in place in order to reduce your latency to a level in order to take advantage of everything that we talk about? Co-location is key. Direct data feed is key. Trading platform is key. Also, co-location doesn't have to be expensive. It used to be very expensive, but it doesn't have to be. For example, the most expensive form of co-location is that your trading server has to co-locate in the same data center as the exchange, NYSE, NASDAQ, whatever. That is extremely expensive. But most of us are happy with co-location at the broker's data center. That's much less expensive. Now, sometimes the broker will also create what's called a point of presence, POP, at the data center, so that you can co-locate your trading server there, and then the broker has a direct link to their own server. So that is pretty good, because I have tried. Interactive Brokers has that service. So we co-locate with Interactive Brokers POP in New Jersey, but their trading server is actually Connecticut. But the time to travel from New Jersey, Connecticut is not via the internet. Interactive Broker has their proprietary network. So it is under 5 milliseconds. Under 5 milliseconds. Basically, the moment you send a trading signal, the interactive broker trading server receive it under 5 milliseconds, and they were able to send it to the exchange in a matter of millisecond also. So the whole round trip is under 5 milliseconds, sometimes faster. So that's very cost effective. It costs you definitely less than $1,000, less than $1,000 a month. Okay, so of course, if your order are so latency sensitive that you need to be directly connected to different exchanges, you can subscribe to extranet. That will cost you more, but let's not talk about in here. Order flow is a big topic. Order flow is sign transaction volume. You know, every trade has a direction. You look at all the ticker tape. Oh, what, somebody execute 100 shares of Apple. Oh, another execute 300 shares in Amazon. Oh, someone execute a 300 shares in Tesla. What does it mean by direction? What do you mean by this? This is a buy order and this is a sell order. Doesn't each order have to have both a buy and sell side? What do you mean that this order is positive, this order is negative? Well, it matters because if an order is a buy market order, it has a positive sign. If an order is initiated by a sell market order, it has a negative sign. So on the lit exchange, every order is the result of a matching of a market order or a marketable limit order versus a limit order on the limit order book. You cannot have two market orders interact with each other. And you cannot also have two limit orders interact with each other unless one is a marketable limit order. So therefore, every execution has a sign, plus or minus, and you can use that sign, accumulate it, and that is a strong trading signal. Many research papers have written about it. It's a strong trading signal, and also that's why people don't, you know, if they want to hide this information, they use dark pool, because dark pool does not generate order flow. Think about it. Why? Because dark pool, all the orders are matched at the midpoint. There's no buy or sell market order. Everybody put the order in a limit order pool, and there's a matching engine. So the reason people use dark pool is to avoid generating order flow. Why? Because order flow leak information. It leak information, and that's what we talk about in this course as well. So now I know that I'm coming up on the 30 minutes. So you know, there's just tremendous amount of paper that discuss how to estimate order flow and what is the order flow impact on the trading strategy. So we would describe quite a bit of that with some exercises in this course as well. So to conclude, MFT is not just for people who want to trade at high frequency or even medium frequency. It's for everyone. It's for everyone who trade, period. Why? Because when you trade, you don't want to lose every time some money to the broker, to your other traders in the market, and you don't want to be, you know, frightened by the possibility of flash crashes or mini flash crashes. In fact, you want to benefit from them. You know, when there's a flash crash, you should boldly step into the market. It's not something to avoid as a trader. It's somewhere that there's tremendous opportunity waiting for you to benefit from it. You should learn to love crashes. That's the measures I wanted you to take home with this course. And you know, so hopefully you will enjoy it. Thank you very much, and you know, let's see if there are any questions.
Wonderful. Thank you so much, Dr. Chan, for this wonderful presentation. And I would now like to request everyone to start putting their questions in the questions panel. And meanwhile, I would also like to share an announcement. So let me just share my screen. All right, wonderful. So yeah, I wanted to share meanwhile when you guys are typing those questions in about our new course, right? So that is on trading in millisecond. So if you can, I hope all of you can see my screen. Just a second. Yes. All right. So yeah. So this course is on trading in milliseconds. Starting, it will be launched tomorrow. So starting tomorrow, we are offering 75% discount on this one. And for all the webinar attendees, this course is available with additional benefits. And so what I mean is, for the next 4 hours, attendee of this webinar can avail a 10% higher discount on top of the launch offer, that is 75%. And I have shared the coupon code on the screen, so you can use that. And in case if you want to get more value out of Contra courses, so this course is also a part of 5 course learning track, that is Advanced Algorithmic Trading Strategies. So if you want to enroll in that, you will be able to do that by getting additional 15% discount on top of the 75% discount. So what I'm going to do right now is I'm going to paste the links in the chat bot, in the chat box, and then you can access the course and learning track here. I have also shared the coupon code there, and so you can access these course and learning tracks. uh, yeah, so meanwhile, let us move to the questions, and I see there are tons and tons of questions here. uh, I have flagged 2 questions and I have to go to more questions. So, Dr. Chan, can you see 2 flagged questions, and if you want to
Yes,
pick
I
them
can
up?
see. Yeah.
Yeah, these are some of the basic questions. I think some of them were asked initially about NBBO, which we later answered. So, yeah, if you find them relevant, yes, we can pick them.
Yes, so Guy Porter asks, isn't the broker required to give your order, route your order to the exchange directly? And of course, once it's routed to the exchange, they are supposed to route it to the NBBO. That's, however, not required. If you think about why it's not required, think about how Robinhood could possibly make money. If Robinhood doesn't charge you commission, how does it possibly make money? They make money by not routing your order to the NBBO. So that is evidence number one that the broker is not required to route your order to the NBBO. They route it to their own buddies that charge you more money. That's how it works.
So I
Yeah.
hope Ashraf, your question is answered. Sorry, Guy, your question is answered. And yeah, we have few more questions. I'm flagging them. So Dr. Chan, you can pick them.
So yeah, is the type of orders reported on the lit market? Well, orders are never reported in dark pools, right? So the question is whether orders are reported on lit market as well as dark pools. Orders are never reported on dark pools, but executions are reported on dark pools as well as, of course, lit markets. When there's a dark pool execution, typically the venue will be marked VINRA. That is to say that because the dark pool reported to VINRA. This execution.
All right. So I hope Ashraf, that answers your question. Can move to the next question.
So well, so it's a very relevant question. How are these techniques relevant to retail traders? Well, you'll find out from the course, but dark pools are accessible for anybody. So like I said, I was a retail trader when I route my orders to Goldman's Sigma X dark pool and find a better execution. I measure, how well the 2 orders, one sent to dark pool, one sent to my broker, and the one sent to Goldman Sigma X has a slightly better execution, so I'm happy. So anybody can send their orders to dark pool. If you don't, you can ask Interactive Brokers to direct your order to a particular dark pool if you like. So I don't see that it's purely a institutional issue. And like I said, for co-location these days, you don't need to use the highest level of co-location to benefit from low latency. Interactive Brokers also, I'm not a spokesman for Interactive Brokers, just to be clear. I happen to be a customer, so I only use them as an example. So the Interactive Brokers as a POP in the New Jersey I don't remember which server, public Equinix, NY4 or something, or NY2 data center, and to co-locate there is not that expensive, probably $1,000 a month. And when you are a retail trader that that you want to earn a living on, if you cannot afford $1,000 a month, that's not a particularly profitable trading strategy. You should perhaps consider a different one. So I would suggest that you pay that $1,000 to co-locate with Interact brokers, and that will save you multiple times. So in other words, every investment you have to consider if there is a return on investment. These are not, you are not spending this $1,000 on a vacation. You're spending this $1,000 as an investment. So the question to ask is, does it earn a return? Does it bring you back more profit than $1,000? That's determined whether it's worthwhile to co-locate at their POP.
So I hope that answers your question, Santiago. Dr. Chan, I have filtered a few more questions for you. So if you find them relevant, we can pick them one by one.
Yes, so the question is, how is machine learning impacting trading in MFT space? Well, machine learning is relevant mostly if you're trading, well, at a high level, machine learning impact everything, of course, but there is no specific impact on the NFT, because here we are talking about particular venue, particular order execution strategy, particular order types. Those are not really issues that that you can use a machine to learn from at this point. So I would say that if you are, of course, developing a high-frequency trading strategy from scratch, and you want to use machine learning to process the data, capturing multiple facets of the market microstructure, of course, that has been, there are many papers on how to use machine learning to do that. But if it is just a measure of effective or efficient execution, machine learning is not, particularly outstanding as a method to handle that. So can we pass order flow, knowing that spoofing might be going on? So to be very clear, spoofing is purely a matter of order manipulation, right? You're sending an order, it doesn't execute, and you cancel it. Order flow, on the other hand, is a little bit of a misleading term. When people say order flow, they don't mean order. They mean execution. They are only talking about actually executed trades, and finding out whether that trade was due to a market buy or market sell order. So it has nothing to do with spoofing. Spoofing, the whole point is that the order doesn't get executed. But order flow only measure executions.
Okay, so Mayank, I hope you got your answer. Dr. Chan, I'll try this. So I'm going to speak the question loudly so that everyone can hear, and then you can answer. I hope that works.
Sure.
So yeah, so this one is by Tommy. Tommy is asking, "Hi, Dr. Chan, can we separate quantitative trading and systematic trading?"
Different terms.
Yes. This next question is by Daniel. Daniel is asking, explain more on how to measure order flow as an indicator. Do I just sum up the time of sales with respect to the buy or sell direction?
The easiest way to measure order flow is if you have access to the aggressive flag of each trade. So if you have an expensive data set, data set have many kinds, and we are talking about perhaps the most expensive kind. These are tick data that give you the aggressive flag of every execution. Then order flow simply is to, if the aggressive flag says buy, put a plus sign to that execution size, and if the aggressive flag says sell, put a minus sign to the size of that execution. And that is the order flow of a particular execution. And then you can just aggregate it over any period you like. That constitutes the overflow over that period.
All right. So I hope Daniel, you got your answer. This next question by is by Thomas. So what would be the key points for creating a dark pool?
Well, dark pools are not created by you or me. They are created by large brokerages, market makers, high frequency trade or big businesses. So we can decide whether to participate or not. Um, and the course will outline some criteria, but one of the major criteria is to measure the degree of adverse selection that a typical trader will suffer in that pool.
All right. So Thomas, I hope you got your answer. This next question is by Pradeep. He's asking, you mentioned about order flow analysis. One could place fake or unintended limit orders, which would lead to manipulated order flow. How does one identify such activity while analyzing order flow?
That's actually a question we have already answered. Order flow does not measure orders. They measure
Yeah,
executions.
perfect. So Pradeep, I hope you got the answer. The next question is by Krishan. Krishan is asking, what book would you recommend, assuming someone already has a math and finance background, to better understand the topic?
Yes, I recommend the textbook by three authors. The first author is Carty, Cartea, and the name is Algorithmic and High Frequency Trading.
Wonderful. So, Krishan, I hope you got your answer. This next question is by Samira. The question is, what kind of data can be used for low frequency trading? I understand for HFT, price data and term data are clean, but for low frequency trading, what other data are used?
Well, if you are not particularly fussy about the market impact of your orders and adverse selection and all these kind of uh, you know efficiency consideration, then the typical bar data would suffice, and that's very cheap, sometimes even free, right? You download bar data, daily bar data from Yahoo Finance is free. If you want higher frequency bar data, there are numerous providers that you can buy from, and they are all very cheap. The only expensive data come when you are looking at tech data, and particularly if you're looking at tech data that involves order book.
Okay. So, Samira, I hope you got the answer to your question. This question is by Alok, and the question is not very clear about the full course. So, this is related to a course, I guess. So, does it include uh, any medium frequency strategy? So can you just briefly, talk about what is covered, like what can be expected from this course, Dr. Chan?
Well, the course actually cover all the aspects you discussed. There is a potential, in any course do not we present what is called a strategy prototype, right? Because think about it, why would anyone sell a course for a few $100s at most for a strategy that actually make money? Would it make any sense, right? No one, that would not make a sense. However, we propose a prototype strategy that you can refine and improve, that you can make extremely profitable. And many people wrote me over the many years in the past that say, my goodness, I created a hedge fund because of your book. And I said, well, did you just copy one of Sargent's book? And they say, of course not. We are not that silly to think that you would disclose all the trade secret for a $35 book. We improve and improve and improve up to the point where we are now managing millions. That's how you should proceed. So yes, the course has a prototype strategy, but it has also many other materials that I cover in greater details.
Okay, so Alok, you can also check out the link that I have shared. So you will see the entire curriculum mentioned there. So go through the details, and you can also take a free preview of few of the modules which are available for the course. That will give you some idea. Uh, okay, so the next question is by Ben. Ben is asking, the order flow of an asset is as per exchange, or is total transaction of the asset from all exchange or dark pool?
Now that's a very good question. So each execution happened in a specific trading venue. So you can say that but of course, when you aggregate the different trade, they will come from different exchanges. It doesn't matter if Amazon is bought on Amex or is bought on, NASDAQ or whatever, Venue X, right? You should aggregate them to measure the total order flow. But again, dark pool does not produce order flow because dark pool the orders are matched at the midpoint. There's no buy or sell market orders there. So 1/3 of the order flow of the US stocks are not available. So that's why order flow on US stocks are not very accurate. But order flow on futures are very accurate because in the futures market, there's only one trading venue, whether it's Chicago Mercantile Exchange or some other, futures exchange. There's only one.
So
each future. Yeah.
So Ben, I hope you got the answer to your question. I am receiving a lot of questions related to courses, related to this course. We will not pick all of those questions. So I have shared this link where you can connect with an expert who will be able to help you out with all your questions that are related to course. Okay, so we'll move on with other queries. So this next question is by Thomas, and this question is, would you consider IOC orders a good way to prevent giving too much information to the market?
Exactly. That's a very good summary of IOC order. IOC order is a kind of a hybrid of a market and a limit order. It's in a sense a market order because it disappears if it's not executed. It won't sit on the order book and let adverse selection to get adversely selected against. And however, it is protected because it has a limit price, so you won't you won't get executed at a price worse than what you allow it to.
Okay, so Thomas, I guess you got the answer. This next question is by Eduardo. Eduardo is asking, what is the main objective of the course? Okay, I will pass this question because this is related to course, so we can move to the next one. This next question is by Guy. Isn't it true that while dark pools don't report bids and ask, they must report transactions within 10 minutes to 10 minutes of the execution?
That's exactly what I said. Yes, orders are not reported, executions are reported.
Okay. So, all right. This next question is by Isaac. Isaac is asking, hi, Dr. Chan. Is modeling transaction cost a focus of MFT? I know this is important in HFT, but I'm curious your thoughts on how that affects MFT as well.
At any you don't have to be a HFT to care about transaction costs. Every trader cares about transaction costs because unless your strategy has such strong offer, maybe generate 50% a year, give a few percent to transaction costs, no big deal, right? But if your strategy is, for example, generating 10% a year, to be very conservative, and you give away 2% of that to transaction costs, which is very easy to do, hey, then you're getting 20% less in profit. Why shouldn't you recapture most of it? But of course, lowering transaction costs is not the only reason we study MFT. We also can create new strategies based on what you understood about market microstructure, even if that is not used for high frequency trading. For example, order flow is a concept that originates from market microstructure, but people are using order flow to trade strategy that have position last for days.
Okay, so I hope Isaac, you got the answer to your question. This next question is by Ken. Ken is asking, how can retail traders access dark pools, for example, for IBKR?
Yes, indirect broker allow you to specify the destination of your order to a specific venue, such as a dark pool. Of course, it may not have destination listed, it may not have all the dark pools listed at destination, but it got a good selection, probably most of it.
Perfect, perfect. This next question is by Chris. Okay, so Chris is asking, how should we use aggregate order flow to trade? If we calculate aggregate order flow is positive, should we buy or sell the stock?
Right. I mean, if its aggregate order flow is positive, you in theory should buy. Of course, that doesn't mean it's always profitable. So you have to backtest how strong the signal is. Some typical parameters is what look back period do you use for aggregation, right? So that's something that you have to optimize.
Perfect. Okay, so Chris, I hope you got the answer to your question. This question is by again Ben. Ben is asking, is it possible to differentiate in the order book what are the orders coming from dark pools?
I would like to re-emphasize that dark pool does not display the orders.
Yes. Okay, so this next question is by Peter, and Peter is asking, since the order flow consider only executed trades, is trade data enough to compute the order flow?
Yes.
Perfect. Okay, so
But of course,
Peter,
that trade data has to come with an aggressive flag. You cannot just say that, oh, 100 shares has been executed on Apple. That won't allow you to compute order flow.
all right. So then we have this next question by Pradeep. So can you please talk a little bit about order flow imbalance and its predictive power?
So there's a possible confusion here between order imbalance and order flow. There's very few people talk about such a thing as order flow imbalance, because order imbalance is what happened at the last 10 minutes of the US stock market close, where the exchange put out an indicator saying that there are many more buy orders at the close than sell order at the close, or vice versa. That's a totally different thing from order flow. Order flow is always in balance. There's almost never balance, because there's usually, there's always a buy and a sell, and it is very rarely possible that there's exactly the same number of people buying as this number of people selling for the same amount of stocks at any given look back period. So yeah, I
Great.
just want to clarify that's this possible confusion of terms.
Okay. So I hope you got your answer, Pradeep. Um, there is also a question on YouTube. So on YouTube, Frankie is asking, sorry, Carlos is asking what language is most appropriate for medium frequency trading, the
Well,
programming
if you are
language.
talking about back testing, you can use any language to back test, from Python, MATLAB, R, C Sharp, C Sharp, Rust, Java, C++, you name it, you can use it for backtest. Most of the time, you should use a trading platform that does not require you to have too much coding. Use no code platform like Composer, Blueshift, or QuantConnect that has an API. That's all very convenient. But for execution, for a medium frequency strategy, typically you need to execute with a fairly high performance strategy language. C# would do.
Okay, so I hope that answers your question, Carlos. Uh, okay, this question is by Novichkov Gleb. There are two questions actually, so he has made some corrections. The question is, what advantages you can possibly get if you receive full order LOG feed from exchange? Exchange charges premium for this kind of feed.
That becomes important when your typical order size exceed the top of book, which is very easy to exceed if you are not just a beginning trader, right? So you want to know if your 1,000 shares order, what's the actual market impact, and you would, let's say, if the market impact is too much, you don't want to send it, then you need the full order book fee for that. And from a backtest perspective, that's also needed to determine the actual market impact of your execution, the actual cost of your execution. Many people are fooled by, oh my goodness, my strategy performed excellent backtest. But little do they know that that excellent result only occur if you're trading only 100 shares. Anytime you have trading bigger size, the execution cost is much steeper. So you need the order book to determine that.
Okay, and there is this one follow-up question. Is Python good for MFT?
Python is a very low performing language, but it can still be used for backtesting, of course.
Perfect, perfect. I'm still seeing there are continuously questions coming in. So we will try to pick as many as possible. So, uh, wow, but like many of these questions are irrelevant. Like people are also asking questions related to chat GPT. Do you want to pick them up? I'm not sure. So, uh, okay, okay. Uh, Okay, we'll pick one more question, and this is by Ben, and that is so the order flow, executed transactions, and volume eventually of the assets will not be the same number because dark pools does not appear in order flow. If yes, so can the missing information of the dark pools from the order flow can be extracted from the stock volume? Hmm.
Let me read carefully. So order flow and the volume. Oh yeah, order flow and volume are not the same thing. First of all, order flow has a sign, volume has no sign. So if you aggregate order flow over, let's say, a 1 minute bar, it could be a much smaller number than the volume, because the volume is take the absolute value of every order flow and add them up, whereas order flow, they cancel each other a lot of times because of the negative sign. That has nothing to do with dark pool. Dark pool does not generate order flow, right?
Great. Okay.
And the last part of the question is, can the dark pool order flow be inferred from the volume? The difference between the volume and the order flow we compute from the lit market, and the answer is no, of course, because you cannot subtract, you cannot take the difference between order flow and volume, because these are two different things. It's like, how do you subtract apples from oranges?
Okay. All right, so I think there is one last question and that I have just received, and it is as a machine learning scientist and a quant, do you see potential of reinforcement learning in medium frequency trading?
Yes. I mean, there are thousands of people already doing that. So it's not a matter of potential. It's a matter of catching up to them.
Great, great. I think we are still getting a lot of questions, but we are running out of time. So, Omre, Rishabh, uh, will be so what I would request everyone there were so many questions, like many of them we were not able to pick in this webinar because we tried to pick as many questions as possible which were relevant to this particular topic. So in case any of your questions went unanswered, please make sure that at the end of the webinar you will get a survey. You share your questions there and we'll make sure that your questions are answered. Okay, and also share feedback and the topics for the webinar, upcoming webinars you would want to attend. That will help us plan more such educational sessions. With that said, thank you so much, Dr. Chan, for this creating this amazing course with us. And I have just shared the link with everyone. So guys, since this is a new course launch, so there are some discounts going on. I've already shared the links with you. So please make sure that you are getting benefit out of it. And with that said, I will now wrap up this session. Thank you so much, Dr. Chan.
Thank you, Kuchiti. It was a great experience. Okay.
Thank you. Have a great day. Have a great day, everyone. Thank you. Bye bye.